We were just discussing how we could render laser eyes for some of us on the call
for the video.
Figure out
Just
how to do it in advance for the video. Yeah.
I was actually thinking,
isn't it that we hoodwink people because we think we're going to talk. They think we're going to talk about inflation, but we're just going to talk about Bitcoin because it's the cure for all.
Yeah.
Including inflation.
Well, I was thinking what we should have had is all had our Jim Rogers hot commodities book up in front of our cameras as pretending we were reading them. And before we did this session on inflation and commodities, which are, maybe loosely connected. Who knows? Connective tissue may or may not be that strong there. I don't know.
Not if you trust the CPI, right? But if other measures for sure.
Hold on, let's crawl before we walk here. Can we do our
disclaimer?
I thought you guys wanted me to go quick and be just loose and goose. Come on, let's roll.
Hot.
Oh,
I told you.
Am I going to do this? I'll do the disclaimer that because I'm
why don't you give it a try?
Most serious around here. So I want to make sure that everyone knows that you should not take anything said on this podcast seriously. Everything should be taken with a huge grain of salt. And it's for informational purposes only. And none of the themes or concepts or insights that we offer on this podcast represent investment advice, and past performance of our intellectual properties is not indicative of future results.
Oh my God. Do you have a
couple
more minutes in yet?
There you go.
That was the best one yet.
That was thorough as it gets. Good job.
That was
all right.
Way more than we needed.
With that kind of disclaimer, we can do anything.
This is how Butler does it, right? He just goes on like so aggressively that we never ask him to do it again. And then he's off the hook. It's a classic Butler move.
Well, I thought that was the right mix of saying all the things I need to say plus a little comedic.
You've covered all bases, and then you can say,
you didn't say that it was also for entertainment purposes. You forgot about that.
I did say that, didn't I? Oh, maybe.
No, you said information.
Okay, well, what
I think that's obvious.
Cheers, gentlemen.
I think that's just,
yeah.
Cheers.
You're so entertaining.
Cheers again. All right.
Happy Friday.
Hold on, but what are we drinking? I'm drinking bourbon.
I am
pretty
actually,
obvious.
I've got an Appleton and Diet Coke.
For those listeners dying to know, Richard held up a Stella Artois, and I have a what do I have? A Moscow Mule.
Moscow Mule. A Russian donkey.
Russian.
The sound is just intoxicating.
That's true. So the topic today is inflation, and in particular, I think commodities, because we recently published a paper on commodities, and I think the asset class is often misunderstood. And so I think obviously the idea of inflation, we should have done like a Google Trends. Can somebody do like a Google Trends on inflation or something
good idea. I can do that. Yeah.
But I think the idea of inflation has certainly entered the investor / market zeitgeist. And we've certainly been getting a lot more inquiries about inflation and how we're measuring it and how institutions and investors might hedge it. And we have, of course, continued to frame the idea of how to hedge inflation in the context of just a broader discussion around diversity and balance, and to give Mike the nod, integration of the different portfolio components, right? So just backing it right up, we are under the pretense that asset markets are driven by unexpected shocks in the dimensions of inflation and growth. And so typically investors have growth pretty well covered, right? They typically have a lot of risk in an equity basket, whether it's sort of domestically oriented or more of a global equity portfolio, but they've got growth typically covered. And the bond component is designed to be there to hedge against disinflation or deflation or lower than expected growth, but is typically underrepresented from a risk standpoint in the portfolio. But what's often missing is this inflation basket, because certainly developed stocks are not sort of fundamentally designed to profit from inflation. And a really good example of that, I think, is if you were to look back 6 or 8 months at the cap weighting of the S&P 500 or the U.S. Wilshire 5000 or total market index, energy and materials, and especially mining within materials, had vanishingly small weights, and the sectors that had the largest weights were growth sectors, typically tech, consumer discretionary, these types of things, and these tech names, which typically are expected to accrue the vast majority of their earnings far out in the future, are particularly they're like high duration assets, and so they are particularly vulnerable to a backup in long rates. And so, lo and behold, we've had a massive backup in long rates over the last couple of months. And in that time period, the cyclicals, the energies, the mining, et cetera, have dramatically outperformed, and technology has kind of lagged this rally, right? And so the developed market indices are not a good way to hedge inflation for this reason. And so you sort of need to think about other ways to hedge it. Tips are one way. They hedge a certain type of inflation. Gold hedges a certain type of inflation. And commodities as a basket hedge a different type of inflation. So I think we're gonna talk about the different drivers of inflation today, and then maybe zero in on how commodities can play an important role that can't be played by any other sector.
Coming from the computer lab, we have the results of the inflation word search, which it's just a moderate breakout in the last little while here since sort of Feb 14th, Valentine's Day. But what is funny is the country with which inflation is searched the most. What country do you think that might be?
I'm going to guess Canada. Is it?
No.
Not Canada. No. Who's got a better guess?
Go ahead. Who's got to get it?
Man.
It's very obvious. It's very
Venezuela?
obvious.
Zimbabwe?
Zimbabwe.
Oh yeah.
Still the number one global search is
Right.
in Zimbabwe, which is so interesting because this kind of brings the humanity to the practice of investing, where when you think about your human experience, so me as a Canadian and Adam, you as a Canadian, we have very different experiences with respect to inflation vis-a-vis Rod and Richard. Right? We've never experienced a hyperinflation or a massive deflation via a fiat currency. We haven't been in Canada. We have been impacted somewhat, right? We do feel 03 to 08 and the huge cycle boom that happens in Canada, but nowhere near sort of the effects that the two emerging sort of market fellows here have.
Yeah, Mike,
so maybe I'll pass that over to you guys.
When were you born, Mike?
I don't want to say 1967.
You were a baby.
What kind of questions that?
He's calling me
thought
out.
it was just us
when there
girls.
I'm
was,
like, how
when
much
the
do you
U.S.
weigh next?
All right, I'm trying to move on. You're still trying. I won't. We're over it.
I know. I'm sorry.
The dollar was cut. The U.S. dollar's purchasing power was cut in half in the 70s, right? At some point,
Yeah.
right? Like a 6-year period was cut.
And the
in half.
Canadian dollar was insanely strong.
Yeah.
That's the funny thing. I recall Jimmy Carter, the era of Jimmy Carter was when the last time that the dollar USD CAD was par, prior to when we came into this resource boom in that 03 to 08 area where the Canadian dollar ripped up. And as I was living that, it was kind of a novel experience. I would say to myself, gosh, I remember when I was a little boy, I was like, I don't know, 5, 6, 7, and I saw a magazine with Jimmy Carter on the front of it, and him being crushed by this Canadian dollar. And it's so funny that it took that long.
Why was that? Why was the Canadian dollar so much stronger? Was it because of the natural resources, and particularly gold
and
mines
natural
that
resources,
all right.
Gold and oil, right? That's where trees, rocks, oil,
And other ores that I guess kind of would make up the basket
ores.
of
Bobby ore, all of them.
Yeah, I mean, inflation is such an interesting thing because inflation in South America is a constant part of our life. It's just cyclical. Like you're living with. I mean, Peru has been since that 7,000% inflation that I've said it too much already in this podcast. It's kind of hovered between 3 and 4% since then. But places like Argentina just seem to have like a 5-year cycle where they blow up their currency, right? And what's interesting when you speak with people there is how they adapt, right? One of my closest friends' dad runs a series of magazines, and the way he survives it, he doesn't really care about the currency much because he just sells space in his magazine. He barters, right? goes to the doctor's office and says, listen, I have this doctor's magazine. I'll put an ad for it, but you got to take care of my family for the rest of the year, right? He's got a travel magazine that he barters for flights and stays in different places around the world. Like he's constantly having these vouchers, as he calls it, in order to be able to kind of handle the vast majority of what his basic needs, or maybe above the Maslow's hierarchy of needs, in order to not be affected by whatever the central banks are going to decide to do to their currency. Right, so you adapt in that way, and this is one of the things that, you know, we're going to talk about commodities and all that, but I think one of the key aspects of how you can protect yourself is to think about, if you have a business, a cash flowing business, whether you have the type of business that can easily, you know, increase your cash flows, or it can be structured in such a way that can allow for your standard of living to remain relatively equal. So you just get to adapt, and a lot of people tend to do that in South America. You kind of live with it. I mean, Brazil, Richard, you have up until recently.
1980s. The 1980s were the big.
Even recently, weren't you guys weren't your yields like 16% 3-4 years ago?
Not that short a while ago. It was closer to 10 years ago. Yeah. You know, prime has fallen to about 2% right now, which is historically we've never had it this low. But in the 1980s, we had quite a strong inflationary process that led to a number of currencies just being thrown out the window. And eventually they created this mechanism that between the real, which is the current currency, and the previous one, they created this unit, this intermediary unit, which was meant to break the back of the inflationary momentum, the self-fulfilling prophecy of inflation. So that inflationary expectation, which in the MMT circles is considered to be non-existent. There's no such thing as inflation expectations for that economic thinking. But in Brazil, it was very much a real thing, because prices were being retagged in supermarkets 2-3 times a day at some points. And we did have for 3 months what would be technically considered hyperinflation in the late 80s, early 90s, I believe, 70% monthly inflation kind of thing. And then finally the real came along, and rates were at one point 40-50% in the 90s, and then they eventually come down. And a lot of that had to do as well with the repositioning of the sovereign debt market, moving away from US denominated debt to Brazilian real, to quench that dynamic in the latter part of that period. So, but yeah, South America is very, very much accustomed to this, and North Americans have no idea how lucky they are.
I don't think we want to, and I don't. No one here is really making a case that North Americans need to be preparing for South American style inflation. But it is interesting to note, like, that we have North Americans do have sort of an isolated existence, and certainly those who were not of adult age in the 1970s don't have any visceral experience with inflation, and therefore the emotional salience that might drive decision making is absent. And so you sort of need to be able to project yourself into that emotional space and say, what if? And right. So I think that's what we're trying to cover here.
That's precisely the point, Adam. I think it's just those who don't have the experience. I know for me personally, not having the experience and talking to Rodrigo and Richard really helped me more emotionally connect to the fact that these things happen, that you do get debasements, that you get these fiat occurrences as well, where all of a sudden there's a sudden transient, what many people are calling, maybe this is a transient inflation. So that's great. It's transient. It means it just passes quickly and happens quickly, and then all of a sudden, you know, the underlying currency that you're holding is worth less, not worthless, but worth a bit less, and it happens quickly. So I think those formative years will shape some of your thought processes around these. And I find sharing the formative years of others who have had very different experiences helps me sensitize myself to those things. And, you know, we had what would be called transient inflation in the 70s. And maybe it's not that. I mean, there's a great case, and Richard, you pop this out regularly, that, you know, there's a whole bunch of productivity tidal waves that potentially can, you know, reduce the costs of the production of goods in many, many, many ways. And that tidal wave continues to grow. Things like machine learning and AI and optimizing everything from transportation to oil fields. Like, these are potentially world-shaking deflationary.
Disinflationary mechanism.
Automation in farming, for instance, things that people
Yeah.
don't even talk about. But just I think there's right now there's a lot of hype. I shouldn't say hype, but there is the feeling that there is pressure when it comes to costs, and it's manifesting in several different places. I would say probably grains have been a major one, even in a deflationary environment of last year with the Corona crash and everything. Grains were up double digits. Soy was up, I think, 30%. Corn was up another 15 or so, and that feeds into not only grains themselves, but also for feeder for livestock.
Supply chain.
And
The supply chain gets affected.
yeah, but the supply chain gets even more affected by energies, which last year just plummeted, but in the last 6 months have been rising quite a bit. And oil's breaking new highs, and that has real strong ramifications across the board. So I think that's something that we might want to dig into a bit more.
Well, look, let's indulge our
but
macro ennui for just a few minutes and sort of describe maybe some of the dynamics that are leading people to become concerned about inflation. And I think a lot of it stems from Stephanie Kelton and the deficit myth and MMT and the idea that, the Congress just passed a $1.9 trillion stimulus plan. They are planning to directly line the pockets of individuals with brand new minted cash. And the question is, where does that demand impulse manifest, right? And if it manifests in the consumption of certain types of goods, then obviously there's going to be some kind of supply shock, and there will be some time before supply can keep up with this excess demand, and that will drive prices higher in certain goods and potentially drive the price of commodities higher, right? But this is, I think, the governments around the world are all beginning to embrace this idea that they're not constrained by the size of their deficits or the size of their debt, but rather they're constrained by the productive capacity of their economy. And so to the extent that your economy is productive enough to allow for money printing, to ensure that there is sufficient demand to up to the point where supply can be offered to meet that demand, then we should make every effort to provide enough fiscal stimulus to create that level of demand, and as a result, maximize employment and the well-being of the citizenry, right? And
I think we should draw, sorry, Adam, just a quick distinction there. The 1.9 trillion has been issued as quote unquote low-powered money, right? The MMT idea is to actually print money that is not beholden to any sort of debt. And as of yet, it's part of the Overton window. It's now discussed in policy groups. It is considered, but it has not yet been implemented, at least not in this last bill that was just passed. It's about to be signed by President Biden. So it's still sort of low-powered money in the sense that there's still more debt going to be issued, at least as far as it's been structured so far. So
well, the plan is to draw down the general account, and
right.
So they don't need to
issue more debt
yet. But we've seen a pretty remarkable backup on rates. We've seen some failed auctions. There's certainly some signs of tightness, discomfort in along the curve. So, I think it's reasonable to be concerned about the fact that the Fed may be forced into acting more quickly than they'd like as a function of this, either due to excess amount of bonds that need to be, or lending that needs to be raised, and or demand shocks showing up in different parts of the economy.
Well, another angle to this whole thing is you have massive stimulus checks going out to everybody with the belief that the sole thing it'll do is grab increased demand. Individuals get it in their hands. They're going to go out and shop and buy items and try to fill the gap that's basically been deflationary because of the coronavirus situation. But as I speak with friends and family that are running businesses, there's another interesting inflationary push here, and it's the fact that when you have people getting free money, my friends and family who own businesses are not able to get bodies to get to work. There is, from receptionists to law firms that are they're getting more hours, and they're making, the partners are making more money than they've ever made in one particular law firm, one of the largest law firms in Toronto, because they have to work more hours because they can't get associates to stay long enough for them to help. They just cannot give them enough money to come to work, because in their minds, they're getting a paycheck, they'll wait it out. It's not a stigma right now to really be unemployed, and so that's putting like price pressures up. They're willing to pay double for an associate in this law firm than they ever have before.
I'd love to see. Is there any actual statistical data to back that shit up? Because I don't know. I don't.
It starts that way. It's not.
I mean, how short-sighted are people? Like, they're going to get stimulus
right?
checks for a few months, and then and extended unemployment payments, and then all that's going to go away. So, are they burning all of their employment bridges? Yeah, man, get stuffed. I don't really want to come to work for the next 3 months because I'm going to get paid, and I know I don't really care that you're not going to employ me at the end of this.
This could be part of the transitory inflation, Adam. It could be part of the transitory inflation, but it is a thing. If you ask around of how easy it is to get low-level employees to work for you right now, it is much more difficult than before. Do you remember Kevin Jardin, who we had on a couple of months ago? He can't. I hope nobody's listening, but he can't get his receptionists to come back to work, right? So it's you're hearing it all over the place, and maybe it is transitory, but it is meaning that they're having to pay more to get. They're asking for more
unskilled labor.
Right, on unskilled labor. So it's either going to show up as transitory, or it's going to be maybe.
Okay, so I'm just going to derail this whole thing right off the bat. So how does this fit with your UBI argument?
It's terrible.
I'm rethinking it.
It's terrible. UBI is
so this one little anecdote about some dude.
One. I gave you 3 anecdotes in my defense.
Ladies and gentlemen, we're pivoting the podcast now. We're actually going to be discussing political philosophy.
Yes, okay.
I just love that, like,
let's say that for tonight's discussion, maybe.
Yeah, we'll see. Well, I need one more drink in you, Phil Brick, and then we'll decide.
You wouldn't bring up. Yes, we could talk about UBI. Maybe we need to modify the conversation. But,
we need to get matching.
Just so Jason Buck knows, the word is transient. He's just bastardizing. It's not transient. It's transient.
Thank you.
Mike said it right.
I did. I'm dyslexic. I barely say anything right. My language is definitely transitory.
Look, I think the point we're trying to make is that there is the inflationary. When people speak about inflation, oftentimes they talk about either CPI, or they look at, if I want to protect myself against inflation, it's going to be gold, or if I want to protect myself against inflation, I'm going to use tips, right, that are tied to the CPI. But as you start exploring, that demand pull inflation or supply push inflation, when you start looking at these different metrics, it turns out that inflation manifests in very different ways. It can manifest in asset prices increasing, housing prices increasing, different areas in the commodity complex increasing at different times. And so it's a much more complex topic than the simple inflation's going up, I got to get myself some gold. I mean, certainly, how's that been working for you lately?
By the way, gold is not really correlated very well to inflation. It's like a 0.2 or 0.3 correlation. It's very low.
It correlates with real interest rates and with money supply.
And with volatility in equities, strangely enough.
And with inflation expectations.
What? And
true.
So it doesn't all accept for inflation. I'd have to dig deeper into that one.
Maybe causation. I don't know. You tell me. I laid at your feet.
Look, I think this is a stat from Raul where median household income hasn't increased since the mid-'70s in the United States. And the only thing that has been able to keep up with those expenses has been gold. So maybe momentarily correlated.
Rod,
I don't know, but
what you've had is asset inflation.
Yeah.
What you have is there's been a perfect hedge to one of the biggest inflations we've had, which is asset inflation. The sad part is that there's a very narrow part of the population that can take advantage of the asset inflation.
Yeah.
But that asset inflation is occurring and has been driven by certain steps that central banks have taken to try and pull us out of this particular set of circumstances. So maybe it's all inflation, but there are other types and ways that inflation is going to manifest. And the one thing, I'll try and bring it back to the commodities discussion. The one thing about commodities that is so useful in regard to trying to prepare a portfolio for inflationary outcomes is the sort of heterogeneity of the complex of commodities. That was a lot to get out of my mouth.
I think we need to, every time I say heterogeneity, we need to drink.
Heterogeneity.
Cheers.
I'm going to say it a lot.
God.
Of the commodities complex is really unparalleled. But it's not that it's just different. It's different in its reactions to those inflation and growth dynamics, right? So when you think about equities in general, they kind of, that school of fish swims similarly. You move to commodities and there's actually very significantly different schools of fish. And you really have to think about that very carefully as you prepare a commodities exposure within your portfolio. Because what you really want, you want your commodities exposure to be significantly different so that your geometric mean return of your portfolio improves with the inclusion of that. And so
yeah.
Go ahead.
Yeah, no, I was just gonna say, I think you're absolutely right. I feel like we got a little ahead of ourselves because part of the other benefit of heterogeneity is that we just don't know where the inflation is going to come from, right?
Precisely.
And what is interesting to note about so it's not like investing in commodities is new, right? It's that lots of institutions have been investing in commodities for many years. There was certainly a major surge in interest in investing in commodities in the early 2000s. And so as a function of that, some indices, commodity indices were popularized, like the Goldman Sachs Commodity Index has been especially popular. There was a Dow Jones Index that was bought by Bloomberg. And so a lot of these indices kind of go from hand to hand to hand, so they're renamed over time. But it's there are some common indices that have attracted a lot of assets. And one of the interesting things to note about these indices is that because they are designed to accommodate massive amounts of institutional flows, they need to construct them so that the heaviest weightings in the indices are in the most liquid commodities. And so if you sort of x-ray through these indices, a lot of them are in the neighborhood of 30, 40, 50% in the energy complex, right? And it might be, I can hear the argument that energy flows through a broad spectrum of costs in the economy, right? It's an input cost to a wide array of things. I think you can make an almost equally cogent argument in the same direction about grains, about metals. Like there's reasons why each of these different commodity sectors might create inflation for different reasons, for different supply demand dynamics. And so what you buy when you buy a traditional index is basically a hedge against rising energy prices, right? And the rest of the hedge is kind of incidental, right? Energy is also very volatile. So from a risk budget standpoint, the overexposure to energies dominates from a cap weight standpoint, but it dominates even more from a risk budget standpoint. So, this is, I think, a major missed opportunity for common commodity indices. It's understandable because the objective is not diversity or heterogeneity, but rather capacity, right?
Yeah.
And so,
you can see that
Rodrigo
if you guys
showing.
see the different major commodity indices that.
Can you zoom in one instance,
Sure.
Rod? Yeah. That's better.
Most of these, and these are some of the oldest ones, have been designed to be able to take in a lot of money. And whatever, one of the reasons why I think institutions decided to buy in on this in the early 2000s, as Adam suggested, is because there used to be this roll yield, if you looked at the data, that you could capture from commodities. There was a little bit of yield that was enough for an institution to say, okay, these at least have some sort of positive expectation. But with all the money that came in, two things happened. That roll yield kind of has gone away, and more importantly, you had to create indices that could take in that load. And so it's just like what you're getting exposure to here for the most part are energies, as you can see from the Goldman Sachs Commodity Index, especially, right? So the question is, if everything that's been discussed here is about the different ways that inflation can seep in. And I think there was a comment from Jason Buck earlier in the chat room about, what
Don't
about
give him too much attention. You'll never get rid of him.
Weather-related inflation is a real
Jason
thing that is going to affect your portfolio, right? So we like to talk about the Fed. We like to talk about how MMT is going to be a problem, but the weather's changing. We're getting global warming, and it's affecting crops, and those crops are going to lead to costly agriculture that's going to lead to food inflation. So you have to hedge all of these different bets, not just the energy bet, right?
And a global reduction of arable land has been a problem that's been mentioned a few times in the last few years. So that is also something that plays in. And the grain complex rising so much may be a manifestation of that to some degree. But I think something that we haven't mentioned yet that is quite important in the whole commodity conversation is the role the dollar plays. I mean, we had Julian Brigden here last week. And the dollar cycle, because the dollar was such a major component of the global monetary system up until the Bretton Woods system in 1971, and then that broke down. But also because of how every commodity on the planet, or pretty much all of them, is quoted in dollars. So a weaker dollar begets a higher price of commodities in all these other currencies.
Yeah, no, that's a really good point. And, so it just sort of goes to show there's obviously a correlation between inflation, the trend in the dollar, and the, shocks to different types of commodities. And I want to sort of raise another sort of spectrum. This is from my earlier days in investing, and goes all the way back to Don Cox. And I remember him talking, sort of his core thesis was about the rise of the middle class in these really gargantuan emerging economies, right? The sort of Brazils, Russias, Indias, Chinas, the BRICS. And, it's really cool. It's triggering because we just had a conversation with Raoul Pal, and he was giving us the case for what was going on in India and just the unbelievable investments in technology and adoption of different technology solutions in the India stack that are enabling Indians to become banked, to be able to do transactions using fingerprints and other biometrics. And this is the way that huge emerging economies rise from the third world to the second world to the first world. And one of the things that happens in every single instance of an economy moving from third to second to first world is you get a massive uptick in the consumption of protein, right? And it's protein heavy grains and it's protein heavy meats, right? So, even a small income shock leading to a demand shock in a place like India with 1.3 billion people is going to have a massive impact on demand for grains and for livestock, as an example, right? So, these longer term themes are also they tie in and interact with climate trends, et cetera, but they shouldn't be ignored, right? And could also be massive drivers of commodity type inflation.
Yeah, look, and at the end of the day, this could all be solved by technology companies that are able to manufacture meat based on laboratories, being able to do what are these
synthesizing meat.
So again, we've never been the type of group to try to tell you that there's going to be this massive inflation. I don't want anybody to take away from here that we're saying you need to buy all of the grains that you can to hedge against this. What we're saying is that this is a narrative that's out there and it could happen, and we need to protect against it. And so if a lot of these inflation factors are going to show up in the inflation complex, in the commodity complex, the many different sectors, how do we hedge against that? Knowing that independently, commodities don't tend to offer any yield, right? Like how do you justify having a zero returning asset in your portfolio just in case something happens in the future? Because
it's
the
a
roll
really good
yield is
point.
kind of dead.
Because
So-
if you look at the performance of these
Well-
indices, basically they've had a zero return for,
But-
the most of the time that those indices have been live. They've had basically a zero return, in many cases negative.
So we're talking about the risk premium that would come from commodities markets, which is either non-existent or transient. In both cases, though, useful. Again, we come back to the objective is if the objective is to diversify a portfolio, and you're thinking about the portfolio's asset classes from the perspective of the drivers of those asset classes, those inflation and growth dynamics that we've all talked ad nauseum about, then it does make sense that when input costs rise unexpectedly, that there's going to be some impacts through that inflation and growth dynamic, and you will be able to offset some of those impacts in your portfolio via a thoughtful exposure to those commodity markets. So
That's right.
that makes sense to
So
me.
I think we talked a little bit about in the past how we've used the rebalancing of a risk parity portfolio that requires the groups of asset classes to be non-correlated to each other from a structural perspective. And of course, the discussion got totally hijacked by the inflation discussion. So like Adam did some work on, well, let's see how many unique bets exist within the commodity complex, and then apply. Let's see what the rebalancing premium is in just the commodity complex. How diverse are they really? And if they are indeed as diverse as maybe there's a yield that you can pull away from that in a more thoughtful way. So I have the paper up, Adam. Why don't you walk people through kind of the basics here and we'll kind of
Yeah, well, let's
everybody's
back it up. So that was a great setup. But what are we looking for, right? I mean, why do people invest in equities? Because there's, you could make an argument thematically about your position to take advantage of growth, right, and productivity, and I think that's reasonable. But the other thing is, there's this historical precedent for equities delivering a premium over cash, and that on a global basis is about a 4% premium, right? 4% premium per year on average for global equities over treasuries, and that comes with like a 16 to 18% annualized volatility, standard deviation of returns. So the question is, do other asset class allocations or allocations to sleeves provide a similar type of benefit, right? So if you look at bonds, well, bonds, you get a lift from duration. So if you if you invest in longer term bonds, you typically get a lift from the fact that you're taking on inflation risk, right? You're unable to roll your bonds at a frequency, at a high frequency, and therefore you're vulnerable to a major rise in inflation that happens over the duration that you hold the bond, right? And so you get paid for taking that risk. And also you get paid a little bit of credit risk on corporate bonds, right? So you get this combination of credit risk plus duration risk gets you some kind of bond premium, right? Typically that's on the order of 1.5 to 2% a year. But you get that at a much lower volatility, more on the order of, call it 4, 5, 6% a year, depending on whether it's rates like treasuries or whether it's you add some credit risk. So equities and bonds deliver about the same long-term premium relative to the risk that you have to take. There's always been an argument that there's no premium for commodities. The commodity premium is zero. And if you look at the performance of commodity indices, like the traditional commodity indices, in fact, the premium is negative.
Now, so.
And
Let me break it up.
Yeah, fundamentally, I mean, it truly a zero-sum game. On each side of every contract is a participant.
Totally, and it has been zero sum for, this goes back to 1990, so 30 years, right? So, the thing is, the commodity premium is not exclusively dependent on the performance of commodities. It is also dependent on the diversity and the volatility of the commodities themselves. And so if you go back to sort of the rebalancing premium paper, what we see is that there's a premium just from rebalancing, like regularly rebalancing between markets with reasonably high volatility and a large amount of diversity. And the more diversity and endogenous volatility in the markets, the higher the rebalancing premium. And this plays right to commodity sweet spot because commodities typically are highly voluble, just ambient high volatility without any leverage. And there's a very large number of independent bets in the commodity space. And so if you just examine the premium from commodities, you're in the neighborhood of 3-4% per year from the commodity rebalancing premium. And guess what? They have about the same risk as equities. And once you sort of diversify across all commodities, so you've got the same expected risk premium from commodities as you do from equities, as long as you are taking maximum advantage of the amount of diversity within the commodity space. And I think this is the thing that's been missed by most other arguments for commodities along the way.
Absolutely. One of the major points. It comes back to, how do you say it again? Heterogeneity?
Yeah, absolutely. Exactly. Somebody fell asleep on their keyboard, so I don't know. I'm trying to read the Morse code. Is that little period of dot in the
I don't know
star
what that
dash?
They're
Yeah,
just
the
trying to clean
comments
away
have
Jason
one-
These
Buck's comments.
SOS? Maybe SOS? I don't know.
That's right.
It could be a
What do you
cry for help. Yeah.
Exactly.
What's interesting about all this is that the inflation doesn't really need to manifest. It's the inflation expectation, or it's the expectation of that rise in prices is what it's
Right.
all about. I mean, I was looking at copper just now. Copper rose 20% last year, and there might have been some supply and demand dynamics there, but a lot of this, I'm sure, had to do with the ESG narrative, and that the trend that you're going to have electrified cars in the coming decades, and there's not going to be enough copper, and so copper has joined the fore in being one of the attractive commodities that's going to benefit from this coming environment. So it's really interesting, and I would also just point out that CPI expectations, or rather the break-even inflation expectations that the market tends to use, have been somewhat affected by the Fed's purchasing of TIPS as well. So that has skewed the measurements somewhat. But again, the expectation is all that is needed in order for
Right.
these trends to manifest and for investors to be able to harvest the benefit of holding some of these commodities.
It's an interesting question, Richard. So what do we do given some of the signals that we would normally rely on to potentially think about the problem are contaminated? How might we do that? Now, I think the step one is, I think we've been circling around this, but you should always have some assets in the portfolio that are diversified, integrated, and thoughtfully deployed in order to be prepared for whatever inflation manifests. So we want to advocate, first of all, that this is not a call on inflation. It's certainly become an interesting topic at the moment. Don't care, honestly, because we're always prepared for the manifestation of inflation in portfolios. So the base case always has some part of the portfolio that is interested in making sure that we're always ready. And then the next thing is, well, how else might you improve the portfolio outcomes by expanding that a bit more? And from that, Richard, we come back to, okay, what do we do now that some of what were very easily, very reliable inflation hedges like a TIP bond are now being influenced by an actual feedback loop? So what do we do now?
Yeah. So just to be clear, I think the assertion is that TIPS should be an effective hedge against CPI inflation, and then it raises a question in the context of the current market dynamic: if the central banks are going to engage in yield curve control, and we've already seen demonstrable massive acceleration in demand for Treasury inflation protected securities, not just at the Fed but in other central banks, to what extent are they going to distort the ability for these traditional inflation hedge assets to play the role that they're designed to play in the portfolio? And I mean, of course, you can go a level deeper. The coupon is reset the value of the bond is reset in as a function of changes in CPI. But guess who sets the CPI inflation basket, right? Obviously, the government that issues the bonds also sets the inflation basket. So there is the potential, and I don't need to get too conspiratorial, but there's the potential for the issuing entity to change the terms of engagement on the contracts. And
you don't even need to go all that conspiratorial. I mean, I think we were talking about this offline, but it all boils down to Goodhart's law, right? Once your measure becomes a target, it ceases to be a good measure. So once the Fed has this idea, that CPI is not going to rise too far above 2%, and they keep telling us that, and for now, maybe for a transient moment, the markets don't believe them. Given the fact that the Labor Bureau Statistics, I think that's what the LBS stands for, controls the basket of CPI, why would that change in disfavor? Why would they allow that to go in any kind of disfavor to the Treasury?
So this is an important point, right? Because we just actually launched a 10-part series called our Masterclass, and in the first episode we talk about who the listeners, what listeners should be paying attention to what we're saying, and we put a limit in the $10 billion as the largest kind of amount of money that made sense, because beyond that you have no choice but to just use things like tips in order to be able to hedge a portfolio, right? Like, this is what we're going to talk about today, and the idea of the commodity complex and the benefits of rebalancing premium and the benefits of that diversification are not attainable for multi-billion dollar pension plans. They're just not. They're
subject to limitations.
Limits. That's right. They're subject to limitations to how much any single entity.
No, flip that, so, Philbrick. I'm surprised you didn't flip that. Small investors have a massive advantage.
Yeah. I was getting.
They don't have enough heterogeneity. You know what I mean?
I'm mad at myself now for not. Did you say heterogeneity? Cheers.
Right. Yeah. Sorry. I'm gonna have to report.
Not only did he say it, I repeated it, so it's two.
There you go, two of them. So the issue, the reason that tips have had to be lobbied for and have as much demand as they have, and are seen as the only inflation hedge, and commodities are kind of put by the wayside, is because the vast pools of money can't use them, right? But if you're smaller, right, if you actually have access and you don't have to buy the index, you can do a lot more with those different sectors in the commodity space than any large institution can. So if I'm just going to kind of keep on bringing this back to the paper that we wrote. I lost audio.
You should, because I think I honestly, the conversation, I would not know that we wrote two great papers, one the rebalancing premium and one
we're orbiting
commodities.
We're orbiting a theme.
Well, I want to explicitly state those now, that people need to read those immediately, or this conversation is not going to make any sense.
That's true.
Yeah. So the key here is, okay, so you're a smaller investor. You're somewhat sophisticated, or you can find somebody that's sophisticated and not be able to play in the space of the commodity. And you're worried that maybe I shouldn't buy any commodities because there is no yield that I can get. Well, I think we talked about the inflation premium as being a very important aspect of creating a synthetic yield. And in this chart here, in figure 4 of our white paper, we show just a theoretical expected rebalancing premium. If we have 3 unique bets in the portfolio, if we have 5 unique bets, 7 and 9. Okay, so if you only have 3 unique bets in the portfolio and you expect a 0 rate of return, you can, from a rebalancing perspective, a rebalancing premium as much as 2%. And if we take it all the way to 9 bets, which is what we end up finding on average in the commodity complex, you can be as high as 4% premium. And it gets higher if indeed we do see an upward drift in the securities and the commodities that you hold, right? And then you don't have to fret too much about whether it will pay off because there may not be any inflation. You still hold it and have that inflation hedge and still yield something that is as competitive as bond yields and equity yields, if not more, right?
It's useful also for people to recognize
figure 4
that.
Here.
Sorry, go ahead, bud. Yeah.
No.
Oh, I was going
think
to say
if we
it's
could talk
useful for
about
people to
roll
recognize
yield.
that, it looks like the commodity indices have had a really crappy time, right, over the last little while. And equities and bonds have had an absolutely phenomenal time, right? Equities and bonds have delivered risk-adjusted performance at 2 standard deviations above their long-term average rate over the last 10 years. So maybe notwithstanding for bonds the last 6 weeks, right? But for U.S. equities, especially in bonds, this has been an absolutely terrific time because we've had a disinflationary growth environment. And obviously that's been the perfect kryptonite for commodities, and commodities have gone nowhere. But there have been other decades and longer than decade periods through history where there has been lots of inflation and no growth, and bonds and equities have both done terribly together, and commodities have done just phenomenally well for many, many years, right? So I know like it's tempting to sort of look at these commodity returns, like the drift in commodities over the last 10 or 20 years, and say, well, there's nothing there. But the reality is, over the long term, even if commodities on average, like if you take all the individual commodity contracts and you say on average they have a 0 expected return, simply rebalancing between them can generate a 3 to 4% return just because of the rebalancing premium that you get from the entropy of such high diversity, high volatility assets in the portfolio.
I feel like you said those words to
And Adam, why don't you go
avoid
through figure
saying
5?
heterogeneity so that we had to drink.
I knew you wouldn't let me get away with it.
It was a nice workaround. Honestly, I am really impressed at the fancy words you used to avoid saying heterogeneity.
Again,
That was
honestly.
spectacular.
Adam, why don't you go ahead and walk
Sadistic.
through?
I didn't see the Peruvian and the Puerto Rican drink. I don't understand.
As people look,
He's trying to keep us on track.
as
did,
people
though.
look to find this rebalancing premium in the most liquid and popular indices. Why don't you walk into figure 5 so we can have a bit of perspective here?
Yep, you bet. The idea here is getting back to the high level of concentration in most of the popular commodity indices. So you've got this sort of GSCI index on the left is the most popular commodity index by AUM. And just using the constituents of the index at the weights in the index, because it's so highly concentrated in energies, it represents very few bets, like 1.2 bets. And just so I don't want to dwell on this, we do this all the time, but the number of bets is equal to the weighted average, where the weights are the like portfolio weights. So the weights times the volatility of each of their corresponding assets. The sum of that divided by the portfolio volatility given those portfolio weights. So assuming diversification squared, that is the diversification ratio. So a higher diversification ratio implies a larger number of bets in the portfolio or independent sources of return. A higher magnitude of heterogeneity is what we're
Cheers.
what we're measuring
Cheers.
here.
Until that happened,
Yeah.
the viewership was dropping like a
I know,
rock.
yeah. Exactly. So the question I wanted to answer the question: can we create sufficient, like a high degree of heterogeneity or a large number of bets from the same group of markets, but just by weighting the portfolio differently to maximize diversity? And
I'm going to need another drink.
so if you're just looking at the GSCI, using the existing index weights, you get 1.2 bets. If you take the same constituents and maximize the diversification ratio of the portfolio, maximize the number of bets, you get 6.7 independent sources of risk from the same group of assets. And again, how does this translate? And this is going to come in the chart below, but this translates directly to the number or to the expected rebalancing premium. So all things equal, in other words,
Yep.
we're still talking about the same group of assets. They have the same ambient volatility. And hey, commodities are a gift because they have a natural, very high level of ambient volatility. And you've got this diversity. So if you maximize the diversity, so you go from the index weights to the maximally diversified weights, you go from an expected rebalance premium of 0.3% per year for the index to 2.9% a year for the maximally diversified portfolio of the exact same constituents as are in the index. And you can obviously see the same type of phenomenon across all of the different indices. So just giving a hint is what's possible if you take all of the available commodities that you could liquidly trade and you constantly seek to maximize the diversity of the portfolio and therefore maximize the rebalancing premium, the potential that you can get from this incredible heterogeneity.
Oh, here we go. Cheers.
I gotta get more ice.
Cheers. Right. So
Hit him with the
I think-
rebalance. Come on, hit him with the number. Gets you.
So on
heterogeneity
average
gets
you get
you-
into the 3.5%, 4% per year.
And how does that compare to the equity risk premium?
Yeah, thanks for asking, because as mentioned, the equity risk premium is about 4% per year. So in fact, you get for about the same volatility. In fact, it's slightly less because the portfolio, like a maximally diversified portfolio of commodities, has a lower volatility than equities because of its diversity, and you get the same level of equity or the same premium as we've observed over the very long term for a diversified portfolio of equities. So it's pretty remarkable.
So how in your studies, Adam, how much did that vary? So you look at the equity risk premium, right? And you can go decades with it being non-existent.
Yep.
And then decades with it being 2 times what it was.
Yep.
What did you see in the rebalancing
I
premium?
love
Was
this
there any-
question actually, because what's the equity risk premium derived from, right? It's derived primarily from the skewness of what I've heard called the capitalist distribution, right? So the vast majority of stocks actually deliver returns less than treasuries, right? There's a very substantial proportion of all stocks that have ever been created and listed on exchanges that go to zero. And then there's another large portion that kind of just are dormant. They don't really do much. They go up and they go down, but over the long term, they're kind of flat. And the entire premium that we've observed, and this is US data, but I suspect that there's thematically or directionally similar conclusions from global indices. But the entire equity risk premium that we've observed in US equities have come from 4% of the companies that have ever been listed, right? So it's really this bet on the skewness of the capitalist distribution. There's a small number of companies that are successful over the long term that deliver the entire premium. But there's actually not very much diversity within the equity universe because the vast majority of the risk in equities is a function of this sort of cyclical risk, right? When there's a bear market, almost all equities go down together. When there's a bull market, they all kind of rise together. Sure, some sectors rise faster than others in different environments, whatever. But there's just
Risk
really not
appetite
that much diversity.
Dictates it all.
Exactly. Yeah. So it really is, there's a large amount of variation in the equity risk premium depending really on growth shocks, right? Are we observing higher than expected levels of growth over a sustained period? What determines the expected risk premium, which is the diversification premium in commodities, is the diversity of commodities. So I will sort of admit that, for example, in the late 2000s, after institutions had adopted commodities as a major asset class sleeve, the liquidity needs of institutions began to dominate the correlation characteristics of commodity portfolios. And so they tended to trade together a little bit more than they had done historically, right? And then as they liquidated portfolios through 2008, 2009, 2010, and everyone lost interest in commodities, that diversity reemerged. So it's not that the diversity and therefore the heterogeneity, man, I got to pour myself another drink, the heterogeneity of the commodity
Don't
portfolio.
say it twice. Just say it once.
No, I'm just trying to get you guys sloshed. Doesn't change through time, but it changes for different reasons. It changes because the commodity sector becomes more homogeneous at times and more heterogeneous at other times. And when it's more heterogeneous, then there's a higher expected premium. When it's more homogeneous, then there's a lower expected premium. So they will both vary, but for different reasons. And I think that's also a really nice benefit because structurally you have diversification in the expectation of the premium.
Yeah. And so
Another layer to this. Go ahead, Rod.
Sorry, I was just going to say that we're constantly continuing to try and increase that yield so that we can participate in case there is an inflation shock across all these commodity complexes. One of the questions asked was, play a role in getting your commodity exposure, right? And this is a popular implementation of trying to get that inflation protection in a bunch of papers. And certainly, intuitively it makes sense. You apply trend when something's popping, you get in. When it's not, you short it. But the trend factor hasn't really been that fantastic all the time, right? It has, just like anything else, just like the risk premium, the amount of bets, it comes in and out of favor. So I think we took it a step further, right? So the first easy way to capture that excess yield was just do the rebalancing premium, right? It's a beta play, and it's a more thoughtful beta commodity complex, and that should get you covered for the most part. And in the spirit of the trend discussion, and I think the Dragon portfolio doesn't get exposure to commodities, but gets exposure to commodity trends. We added to it. Are there any other alpha signals that could help us yield even further returns from that commodity complex? Because if you bets, you can benefit from all types of skews and styles. So at the end of the paper that we wrote, we actually tried to see what would happen if we, I'm about to share my screen again, but what would happen if we add styles like trend and carry and skewness and seasonality and the like to this complex. And I don't know, are you guys seeing the screen yet?
Not yet.
No.
But
No,
we've
yeah.
said that hetero word so much I can barely see my own microphone.
Mission
But if you guys recall, what you end up getting from the traditional energy weighted indices is basically a squiggly line that annualizes. Once you add the rebalancing premium, you get a couple 2 or 3% excess returns. Once you start looking at trend and skewness and seasonality and value, they all added value at different times, right? And the combination here shows for those listeners, we go from 0 to the rebalancing premium approach, adding 2 or 3%, to the combo approach of using all these tilts, adding 7%. And Adam, I believe this is long flat, right? You're not shorting
Correct.
any
Yep.
of the commodities, right? So it's still the idea of being long commodities at all times, but having the weighting scheme be tilted more towards some characteristics and styles at different times that can help us, capture a bit more of that yield that everybody wants. And anyway, bringing it full circle there.
No, that's great. And what's amazing is this, this is ignored, right?
Totally.
Everyone talks about sort of trend, but how many people are talking about commodity seasonality as a strategy that they're trying to allocate to, or there's some people are talking about carry, et cetera, value, but when you put them all together, it really is remarkable. You've got this long only exposure to an asset class that is really one of the only ways you can get protection from certain types of inflation. And you're able to pretty profoundly increase the expected performance from this through proper diversification and tilting towards very intuitive styles, right? It's very cool. And if we can really geek out for a second, one of the other interesting things that we've sort of noticed about commodities is that they have extremely high information content. Like the fractal entropy, for example, for commodities is just extraordinarily high. There's just a lot of independent dynamics operating on each commodity complex. There's a lot of different actors acting for different reasons, and it drives the information content of these commodity indices to be very high. And a high information content is the holy grail for machine learning. There's a lot of information density to learn from, right? Now contrast that to stuff like bond markets, where think of the type of equity return that has the least information density. It's a straight line up, right? There's zero information density in a market that delivers a straight line up.
And one marginal buyer.
Sure.
Out
Yeah.
late.
And major moves are done by policy.
Yeah. So
Right.
like bonds, right? Bonds have very low information density. They're kind of as close to a straight line as you can get, certainly over the sort of over the modern era, right? Commodities have enormous information density, and therefore they are extremely fruitful for machine learning approaches. And certainly that's what we found in our core alpha products. And I think that's extraordinarily interesting. There's one more reason why commodities are an interesting asset class, and that fewer people should overlook them.
I'll add another layer to this, which is the fact that because of recency bias and because we haven't seen inflation manifest in any meaningful way over the past few decades, everyone's underallocated to commodities. And it adds this potential for incremental dollars flowing towards the asset class, having a meaningful impact into the direction. And so just this really pop in expectation has been enough to see double-digit rises in last year, in 2020, across the board, particularly in grains and metals. And now in the last 6 months, I would add energies to that. And so I'm still not convinced whether this is going to be transient or transitory, if you want to call that, Rod, inflation, or if it's going to follow through. But the fact of the matter is the market is now pricing this as a real possibility. So how does one position for this?
Well, yeah, so we're in a position right now where, because the market cap of investable commodities is so small, the price elasticity of demand is extremely high, right? So you have a major potential increase or decrease in prices as a function of relatively small increases in supply and demand for commodities themselves. Yeah,
that's right.
Nothing gets anyone negative on oil than minus $37 oil or whatever it was.
That's right.
Well, but oil is funny also
squeezes it out. Well, it's not just oil. The point was that there was a massive demand shock in 2020 that caused downstream decisions that are actually a little bit longer term than one might think. But, when you close certain, in particular in the energy space, when you close certain wells, they're just closed. You don't reopen them. They're just done. And they had no place to put whatever product they were producing. And so, this is the quintessential. Nothing solves either low or high commodity prices like low or high commodity prices. Quintessentially that. But I think what you're saying is you need to step ahead by 1 or 1.5 derivatives of thinking. What's obvious in the market are the expectations. The expectations are priced in. What you're trying to figure out is, what is the change in expectation going to be towards? Yeah. And where is it going to be? How is that going to be meaningful? And that's where the price shock or change occurs.
It's funny how we misremember. I don't think a lot of people remember what happened. I think it was March the 9th when Saudi Arabia came out and saw the opportunity to kind of, if not ruin, at least kneecap the U.S. shale industry by opening up the floodgates. And that's what actually drove crude oil all the way down. So the energy complex is particularly interesting and complex and multidimensional because you're at the mercy of this cartel of countries that are.
Richard, you're actually the idiosyncratic nature, because I didn't want to say the other word, of each. I can't say the other word again. Of each particular set of circumstances around the commodity with which is being discussed, targeted, however you want to talk about that. That is the beauty of the commodity complex. That's it.
Yeah, and look,
very much so. And the public indices are all. Sorry, Rod, you go. I was just going to say that because the public indices are also beholden or also meaningfully correlated to oil because it represents such a big weight, they are much more at the mercy of this particular idiosyncratic risk and this particular dynamic of those countries that make up OPEC, as opposed to a more diversified risk balance.
Well, they don't get the diversity, right? When you put 60, 80, so I think if we risk weighted it, it's probably 90% risk weighted towards energy. I'm going to guess. Maybe it's not that high. There's your bet. That's the bet you have. That's the unique contributor to the portfolio. So
it's add a really interesting question. GSCI. I'd love to see that.
and you've added this one sort of bet, but it's an energy bet. It's not a gold bet. It's not a debasement of fiat currency
it's a single type of inflation hedge that is highly controlled, right, by a handful of people around the world.
And I would argue it is unique. Like it is different.
Unique. But like every sector in the commodity complex is unique and has its unique players that drive the market and push in different directions. Here's what bothers me about this whole like beta, getting exposure to beta and commodities thing. That whenever I brought up, listen, you should probably be more thoughtful about how you hold your long positions in commodities. They're like, well, I'm looking for a beta portfolio. I'd rather just do the commodity index. But like the best performing commodity index has an active roll yield program underneath it, right? So it's all about like they recognize that there is a structural benefit that they can take in order to be able to provide somewhat of a yield for the investor. And so if you take it to the level of, well, what if we rebalance better and give you that yield, it starts becoming more like, well, that's active, right? And if we take it all the way to trend and long only trend, because if you want it as an inflation hedge, you want to have the long only positions. You don't want to be caught out on a big short at the wrong time, right? So you have your long only with tilts that provides a massive benefit, much better than the roll yield. Well, people start getting jittery about whether that's true beta or passive, right? I don't know. It's just you're doing it anyway at a smaller degree. You might as well just go all the way with this long only beta.
No, agreed, Rod. If you're going to make the foray, why
Yeah,
would you want to do it? So, well, one reason is size. Right. So if I don't have size and I've got to allocate passively, I'm getting sort of a bet. So I'm just going through in my mind. Okay.
The Abu Dhabi pension plan, you can get off the line now. This isn't for you.
No, I think Mike, what you're saying is if you're not sufficient size, and you kind of have to take what you get from ETFs, right? And
both. You're massive.
If you are massive,
if you're in the tails.
Yeah.
Correct. So how if you were a smaller investor, how would you create this rebalanced equity? Or not equity, commodity risk premia. But again, I think that misses the opportunity to really fully integrate. And I know I get skewered for the integration side of it, but there is also a massive potential. Well, the whole rebalancing premium of the 13 bets in the paper is about integration.
Yep.
It's about not separating into baskets of, I have my bonds, I have my commodities, I have my stocks, and I'm going to be in these three buckets. No. There's an integration factor that happens between the three buckets.
I think you need to get mad.
Also,
get mad about the popular risk parity products. What is it about that really makes you mad? Let's hear it.
That triggers me.
Yeah.
You mean leveraged stock bond portfolios with a smidge?
Well, that's a whole other level. But I mean, just in the portfolio construction of the really popular, and I don't want to name the popular.
Right, no, we won't name them.
Yeah.
There's a form of bucketing.
According to Alpha Adder.
But there's right there. And they're 40-40-20. They're 40 stocks.
Oh, that's another point. Yeah.
Yeah, 40 bonds and 20 commodities. And the reason they're 20 commodities is they can't get to a full third. And they don't integrate. These are siloed buckets that are viewed outside the purview of what potentially could be their integration. And when you think about their integration, I don't know, there's soybean oil, there's beans, there's meal. That complex may be going through something that's quite complementary to the overall portfolio, or should maybe more dominate the commodity portfolio, or should be rebalanced back to within the context of the entire portfolio. Well, when you silo these things, you're just giving that up. You're saying, I don't know, I can't do that. And then when you say I'm 40-40-20, which again speaks to recency bias, right? It speaks to overconfidence. So there's people that like risk parity, and they may like risk parity for the wrong reasons because it's actually kept up. Well, it's kept up because it's 80% financials, half of which is stocks, half of which is bonds, and 20% commodities. That's been a great place to be. That may not be a great place to be as we march forward. And in meaningful timeframes, like these are a 10-year time frame is really not a meaningful time frame. These regime shifts last 10 years. I mean, I remember when everyone was so hot in the NASDAQ like we are today. I get it. The year ended in 99. It was a great 15 years for NASDAQ stocks. Not at all. And there's lots of difference between then and now. So it's not a comment on. There's not. I don't want to say it's a bubble. It's not like that at all. That's not what I'm saying. It's just it's interesting that people's sort of receptivity for certain asset classes is hugely influenced by the recency bias, which then influences their overconfidence.
Yeah.
And I come back
look,
to
the commodities for in the 70s were up 800%. Gold was up 1,400%, right? Commodities in our paper were up 0%. Right? What was the year from 1990 to now, right? So
Yeah, 90,
you're looking at
yeah.
30 years where you analyze at zero. Well, yeah, it doesn't always have to be that way, right? It doesn't always happen that way. And in the meantime, again, this is why you want to have a little bit of premium, however you want to capture it, so that you don't have to live through it necessarily as much. But it is interesting how for years we've been talking about this, and it's only now after the 5-year break-evens are going through the roof. They're like, okay, I'd like some of that now. After like energies are booming, like all of our P&L in our hedge funds are just all of these commodities.
Dominated by commodities, completely dominated.
Completely, like softs, grains and whatnot.
Yeah. So you raise a point on the premium. Brian Moriarty asks a good question. What's the best way to capture this premium? The schedule rebalance or triggers at certain points or portfolio percentages. So whether the portfolio is drifting away from predetermined weights. So that's something that we do
That's
cover.
proprietary. Next question.
Well, I mean,
Show them the link, Ani.
No, but what's interesting is you could, like the premia that we've been describing are captured through really simple time-based rebalancing, right? So it's there are more complex ways of rebalancing, like rebalancing pairwise rebalancing as a function of different types of lead lag oriented correlation metrics and that sort of thing. But you can capture a very substantial portion of the available rebalancing premium by just rebalancing at a daily time frame and maximizing the diversity of the portfolio, the heterogeneity of the portfolio, and rebalancing with highly volatile assets, right? Which is, I mean, again, I can't hammer this home enough. Commodities on their own are very volatile and they're very heterogeneous. These are extraordinary properties to generate a rebalancing premium. And it just chronically gets overlooked, and you don't get any rebalancing premium from any of the indices. And I think that's a real shame.
Notice how we didn't even bring up Shannon's demon in all this, because that's kind of the ultimate example that we, at least offline, we tend to bring up as a sort of the perfect corollary to why this actually works.
Yeah, so Shannon's demon is really from information theory. It measures entropy, and so it goes back to the information content of the markets and the chaotic nature, or a measure of the chaotic quantity, the chaotic information in markets. And again, commodities have an enormous amount of fractal dimension, and that fractal dimension allows you to rebalance at a variety of different frequencies and capture this extraordinarily large rebalancing premium from what is ultimately just an obscenely naive strategy, right? Like just maximize diversification and rebalance. Like it's pretty remarkable that you're able to generate a premium that's that large from such a simple methodology.
Just because it's so interesting, I was just putting up some random commodities on the screen. Because you're used to seeing charts, and you might see two lines that are very different from each other, right? Bonds and equities. And then you look at the equity composite, and they're largely the same. I mean, this is just, I don't know, gold, corn, platinum, silver, sugar, Brent crude. They're all over the place, right? You don't see this level of heterogeneity anywhere else, right? Just in the public markets anyway, right? Of course, again, who are we speaking to? We're speaking to the smaller players, of course. Right? You can't do this as a big institution, but if you can play in this field, look at this. Amazing opportunity.
Yeah, huge. Absolutely. Now, why didn't you add Bitcoin to that chart? I don't understand. We had this opportunity.
That's right. We forgot to talk about Bitcoin. So when is
to
Bitcoin
add
a
crypto
commodity?
It is a commodity contract. It is a commodity contract.
Well, you could just put for stock chart $BTCUSD. Just add it right to the chart. But I mean,
Don't do it.
I only say it because
don't do it. Don't do
it
it.
is fun, notwithstanding the whole crypto angle.
Hetero
of this thing.
crypto.
Exactly. But it's a highly
Well, that's not
volatile
bad,
market
actually.
that is uncorrelated to all the other commodities. And so it's literally adding a pure independent bet. Now you do have the challenge if you're gonna allocate to it as a future, it's got a really negative roll yield. So you got to overcome that, and I wouldn't advocate
This is interesting
that necessarily, but
because the roll yield is an interesting thing both in Bitcoin and in bonds.
yeah,
I don't think people sort of understand how that works either. Maybe someone else will do it because I've had too many hetero drinks.
yeah. So,
Try and explain it.
yeah, I mean, the idea here is right.
Hetero.
With futures, you've got spot futures, or you've got a front month future, and you've got a back month future, and then there's oftentimes, depending on the contract, you've got many. Like maybe it's March, so we're soon going to be rolling into the April futures for many futures contracts, and maybe we roll into the April futures and we look at the May futures, and the May futures are trading at a price that's below the May futures, and therefore what we'll expect is that the May futures are going to rise in price towards the April futures, right? And so it's that gravitational pull that gives you the roll yield, and it's a real yield. It's like a yield on treasuries or what have you, and it is so carry, which is measured in this sort of roll yield, is what you expect in terms of return if the price doesn't change, right? It's just like you're getting dragged up or dragged down towards spot.
Yeah, the distance between spot and the contract you're looking at.
Yeah, or front month and back month, exactly. So commodities, because they have this term structure in the futures markets, they have positive roll yield or negative roll yield, and it's an important component of commodity returns.
And you can capture that positive roll yield depending on whether it's upward sloping or downward sloping, contango backwardation, by going short when it's downward sloping, short when it's downward sloping. And
or
is that right?
Yeah.
long
Short
terms, rather.
negative expected carry markets and long positively
Correct.
expected carry. And that is the carry strategy on commodities that Rodrigo highlighted in the chart earlier, right?
right.
And there's obviously other dynamics in play.
Here's Bitcoin. So whatever, it's all right. But I guess
Don't
We're
even.
talking about the
I almost shoot
heterogeneity,
my-
not the trend.
Oh, not again.
look at this. Look at
There we
this.
go. There we go.
Boom.
What is it?
That's what I'm
Raoul
That's
Pal
for the
said that
for the month of March.
the growth the growth rate of Bitcoin is 99 million % since inception or something. Was that the number he cited today? I need to go
was-
check
Well,
that.
it
but
started
yeah.
around some cents. Well, it started around a couple cents,
Yeah.
and it's at 57,000. So not
Yeah.
that surprise.
I know you did that math in your head. I got it.
I did, didn't I?
There's the denominator effect again.
I think
So just to summarize,
when
right,
it comes to Bitcoin, I think. Yeah, go ahead. Finish up.
Go ahead, bud. No, you were going to say something about Bitcoin. Go ahead.
No, I was just going to say that the thing about Bitcoin, because some people are asking whether Bitcoin should be considered a commodity, it's an inflation hedge. And I think the idea of Bitcoin as digital gold has merit to it for sure. I think it can be a store of value. I think the network effect has gotten to a point where it's going to be nearly impossible to kill it. But as Raul likes to say, I like his framework, which is that's a portion of it. The other portion is you're in a point of maximum ingenuity, maximum innovation, and that volatility is everybody coming to play in that field. Creative destruction, frauds here, success is there. We're going to find something over the next 10 years that is going to stabilize more toward that level of market cap and volatility that we see in gold when everybody finally adopts it from a network effect perspective. So today, it's just, even if you put it in a portfolio, if you're looking at a rebalancing premium and you're looking at volatility measures to make sure you're keeping it in line, it would be a very small portion of the portfolio, regardless. Right?
Now Jason Buck's going to be all over me to write a crypto rebalancing premium paper. I'm never going to hear the end of it.
Well,
So
that,
thanks
that's
for
going to
that.
be easy. 99% Bitcoin and rebalance the 1% in the S&P.
No, I like cross crypto, Litecoin, Ethereum,
Oh, you're
Dogecoin,
the Doge.
Boobcoin. I don't know, whatever.
Come on, you got to love the
Boop
Doge
coin.
coin.
Never
Yeah.
heard of
The
Bitcoin before.
Doge. Come on.
The douche abides. Yeah.
Yeah.
The
The
Doge.
Doge
buy.
abides.
So
right.
yeah,
Too
so
good.
just to bring this whole thing first full circle, let me see if I could still sort of summarize here. But we talked about why inflation is capturing attention, how there's minimal emotional salience and sort of emotional urgency on inflation because the vast majority of market participants have never experienced inflation firsthand. And so it's only sort of secondhand or allegorical that we think about the risk of inflation. And so it helps to hear stories from those who've lived through inflationary episodes to make that more real. And we talked about Rodrigo and Richard's direct experience with inflation in their home countries. And then we talked about how to think about commodities as one potential hedge for inflation and some of the positive benefits for other hedges like tips. And we didn't really talk about inflation or real estate rather, but real estate has historically been a reasonable hedge for inflation. And we've certainly seen a massive uptick in real estate prices in many jurisdictions. And then we talked about investable commodities and how many institutions are choosing to, at the margin, increase their allocation to commodities as an inflation hedge in recognition of a lot of the sort of modern monetary theory type policies that are coming down the pipe and the potential risks introduced by that. The flaws in the typical indices that these institutions choose to invest in to hedge this risk, including primarily concentration in energies and a lack of diversity and heterogeneity. Here I am, I'm all out of drink again, so I can't participate. And the potential rebalancing premium that you can get from a properly constructed commodity index that takes full advantage of this heterogeneity and maximizes the long-term rebalancing premium. And
Mike's on the floor. Mike on floor.
and how that long-term rebalancing premium for commodities, if done properly, can rival the long-term expected risk premium from equities, and at the same level of risk, the expected risk premium from an investment in fixed income. So both the duration premium and the credit premium.
And it's more reliable. I don't know if we actually
I don't know if I'd go
point.
I wouldn't be so confident that it's more
Yeah,
reliable, but
that's
it's
fair. That's fair.
But it is definitely, the variation is due to different dynamics. So you get the structural diversification and why you'd expect a commodity.
Precisely.
Which I think is beneficial.
More reliable is totally because someone would look at it and say 20 years of reliability in the equity risk premium. That's pretty awesome. But what about the next 20 years where it's not reliable? So if we were to look over time frames that people are most likely not going to look, it's an inaccurate statement. So
when you're averaging, sometimes you're going to be averaging 20 unique bets. Sometimes you're going to be averaging just a handful, right? So if you have a long period where these sectors are correlating to each other, that entropy necessary to have that quote-unquote reliable rebalance is not going to be there. But like everything, like every risk premium, as you said, Mike, it ebbs and flows, right? So reliability is more of if there's going to be entropy in these long-lived assets, if we're doing this not to trade something for the next month, quarter, year, or two, if you're doing it for a portfolio that's going to be there for 30 years or 100 years, if you're looking at your legacy portfolio, then I think it's reliable, right? And then one thing to wrap it up is the styles that you could skew to as well on a long only portfolio that could increase that yield for you as well. So I think that I'll end it with a lot of this content has been done in a more concise manner with our master class that we're launched today. Actually, we went live with it on the YouTube channel now. You can go. If anybody wants to do another 2 hours of hearing Mike Avenatti,
it's going to be such a great weekend.
Go to YouTube, and I think it's been pushed to most of the major players. It'll take a while to update because we're updating our previous 12 days of investment wisdom podcast that was more geared towards retail investors. This is more individuals that have large pools of money that they need to manage for decades, 30 to 100 years. And
Well, where you're
a lot
going
of
to experience all the economic regimes.
That's right.
For
That's right. So
for
take a
significant
listen,
amounts
give
of
us your
time.
feedback. A lot of this is covered there, and reach out, tweet at us, like, share, all that fun stuff.
You guys went way too easy on us today. I thought for sure we
Yeah.
were going to get challenged, but these guys were
Yeah.
really.
But I mean,
There
when
was
they
that
say
one guy
tweet
who
at us,
slept
leave
on the
me
keyboard.
alone
That
for
was
about
challenging.
4 or 5 hours. You don't mind.
We were asked
You'll
to say
self-flagellate, you know?
skitter. We were asked to say heteroskedacity 5 times.
Oh,
fast.
I love a
Go, Mike.
heteroskedacity. That's easy.
Heteroskedasticity. You missed the whole syllable.
well,
there,
that's
dude.
totally
Honest to
different.
God.
Oh,
That's not what I
man.
was told.
Yeah,
that's not what
I just went with what I heard.
My Peruvian eyes only read.
I'm
maybe
all
maybe
oral
Canadian.
all
It's
the time.
transitory
English words.
heteroskedasity, I think is what we're.
We definitely should not have played that game. Half of this
I'm
podcast is
totally-
completely out to okay. Sorry. Yeah.
Too good. All right.
All right. Well,
As
by the
always,
way,
thank you,
I just
gentlemen.
want to do the shameless plug on the rebalancing premium, which is a white paper, and you don't even have to give up your email address. We just give that away. That's like money laying on the sidewalk. And then if you would like our optimal commodities, download,
Paper.
then you're going to have to pay the huge price of your email address.
Yeah,
Both will be
think long
worth
and
it.
hard.
It's really tough. Just make up a fake email address so you can make
Oh,
the extra
Jesus
4%.
Christ, Michael.
This is the
So you
mic
can
I
make the
paid to
extra
see.
Our
4%
marketing,
per year,
our head of marketing in the background
In
is banging her
perpetuity.
head against the wall.
forever. I mean,
I can't
whatever.
wait to play against Mike
Is
tonight.
it worth
on both
your
ends.
email
I just
address
can't.
to get an extra 4% a year? I don't know.
No brainer in my opinion.
Oh, look at that! Yeah, it's more worth to give the wrong email address for 4% a year. Apparently,
That's
That's
true.
good advice
For
there.
sure.
all right. On
So
that
none of
note,
you open
go and
mic. Here.
apologize
No
to
one's
Andre.
got
What's going
a
on?
hard question to ask. Come on.
5:30.
You're 90 minutes in, so I get it. If you're a little bit, your brain's
Yeah.
kind of frazzled, but
I got it. I'm frazzled.
yeah. I'm just
We
getting
haven't
started.
checked.
I'm just
Twitter
wondering about
questions, so
the,
has
the-
anybody
the
on
guy
Twitter we
who's
should
the
have
guy
somebody-
who's listening right now. What's his question?
Yep, you're right. Let's wrap it there.
Oh, it's not even a guy. It's
All
my
right.
mom. Damn it.
That's right.
Yeah, let's
That one
wrap
was
it there.
getting
About
good.
7 minutes ago. Let's
Yeah,
wrap it right
exactly. Yeah. Thanks for listening,
All right,
guys.
gentlemen, see you at poker
um,
tonight.
Yeah,
Yeah.
that's right.
Yeah.
Have a
there.
good
See you guys in a
evening.
bit.
Bye now.
See ya.